Welcome back to The Explainer. Today, we're diving headfirst into a massive financial mystery. We've got a company experiencing absolutely staggering revenue growth. They're securing these massive government contracts, and yet their stock is just crashing. So let's break down the data together and figure out exactly what is going on with the SpaceX Q2 2026 earnings paradox. Okay, let's dive into this. If we start purely at the top line, the numbers are absolutely wild. I mean, in the second quarter of 2026, SpaceX posted an incredible 92% year-over-year revenue growth. They raked in $7.8 billion for the quarter alone. But here's where the paradox kicks in. Despite that record-shattering revenue and despite their core profitability, their EBITDA, growing by an astonishing 191% to hit $3.5 billion, the stock has completely plummeted. It's literally lost roughly 50% of its value from its recent highs. So, we have to ask ourselves, why on earth does a company with record-breaking growth and basically near monopolies in its core businesses lose half of its value? For any investor, or really just anyone watching the market, a contradiction like this is a massive red flag. It tells us something else is going on under the hood. To solve this mystery, we really need to dig deep into their financial statements. And the first major clue to this puzzle? It's that SpaceX is undergoing a massive fundamental transformation. Their top-line revenue growth isn't just coming from launching rockets into orbit anymore. Actually, in a very real way, SpaceX is quietly functioning as a massive artificial intelligence cloud infrastructure company. And this brilliantly illustrates the fascinating divide going on inside the company right now. On one side, you have their traditional space and launch segment, which is naturally seeing slower growth. But on the other side, you have this hyper-growth, incredibly high-burn AI segment that is completely rewiring the financial makeup of the entire organization. Just look at how fast this side of the business is accelerating. Back in Q2 of 2025, their AI segment brought in about $737 million. Fast forward to Q2 of 2026, a massive $2.5 billion. SpaceX has essentially morphed into a digital landlord. They built up a staggering amount of AI computing power. We're talking up to 1.4 gigawatts, and they're renting out all that spare compute to tech giants and hyperscalers like Google and Anthropic. Since the industry's demand for compute is far outstripping supply right now, they're driving absolutely massive top-line revenue just by leasing out this infrastructure. And they are aggressively doubling down here. They recently announced they're acquiring the AI startup Cursor for an eye-watering $60 billion. They basically used their highly elevated share price, back when the market cap was soaring over $2 trillion, to fund this massive expansion. They are trying desperately to stay competitive in an AI race where their own model, Grok, is arguably sitting in fourth place behind heavyweights like OpenAI and Anthropic. But here's the catch, and honestly, this is where we begin to uncover exactly why Wall Street is reacting so negatively right now. Playing the role of a digital landlord and trying to compete in the global AI race, that requires an absolutely phenomenal amount of upfront capital. So, the crucial point is where their money is actually going. Out of a massive $18 billion in capital expenditures for the quarter, nearly $16 billion of that didn't go to spaceships or satellites. It went straight into building out AI data centers. Let's translate that into plain English for a second. When you factor in their operating costs alongside this massive infrastructure investment, SpaceX had an actual cash burn of about $15 billion in a single 3-month period. For Wall Street investors, that is a terrifying number. Even with roughly $100 billion in cash and marketable securities sitting on hand from their recent public offerings, burning $15 billion a quarter means their financial runway is shockingly short. They'll likely be forced to come back to the market to issue more debt or print more stock pretty soon. And while the AI side is burning through cash, their primary profit center, the Starlink connectivity business, presents a really nuanced trade-off. So, yes, total subscriber numbers successfully doubled, going from 6 million to 12 million year over year. That's great. But to achieve that crazy growth, the average revenue per user actually dropped by nearly 25%, falling from $85 a month down to $66 a month. So while total revenue is up, investors are watching this super closely to make sure it doesn't turn into a long-term habit of race-to-the-bottom pricing. Now, what's really interesting about this slide is the pricing dynamic in the traditional space segment. Think about this. Their total launches actually dropped from 46 down to 38. The actual payload mass delivered to orbit dropped from 652 down to 485 metric tons. Yet, remarkably, space revenue grew from $746 million up to $962 million. How does that even work? Well, it's because SpaceX enjoys a near monopoly on the launch category. Even while doing less actual volume, their sheer pricing power allowed them to command way higher rates from their most lucrative customers. But despite that incredible pricing power in space, we have to bring things back to the brutal reality of the stock market. Because ultimately, stock prices aren't just about how incredibly cool a company's technology is, right? They're about math, they're about supply, and they're about expectations. Even after this massive 50% sell-off that we talked about at the beginning, SpaceX still holds a staggering $1.6 trillion valuation. For a company currently generating roughly $30 billion in annualized revenue, that is a massive multiple. A price tag of $1.6 trillion requires absolute, flawless execution just to maintain it. It's essentially pricing in a future of total market dominance. And right now, that astronomical valuation is running headfirst into a major structural headwind. We are staring down a massive insider share unlock. In just 2 days following this earnings report, 911 million shares are going to become available for early investors and insiders to finally sell on the open market. Retail investors are deeply, deeply concerned that this impending flood of supply is going to drive the stock price down even further. So, faced with these very real spreadsheet concerns, a $15 billion cash burn and impending share dilution, company leadership took an interesting pivot. Specifically, CEO Elon Musk on the earnings call completely bypassed the immediate financial headwinds and instead focused investors on an unimaginably vast long-term vision. I mean, the revenue targets stated on this call are incredibly ambitious. Musk stated that hitting a $100 billion annualized revenue run rate by this December is essentially a given. Beyond that, the company has heavily accelerated its internal target to hit $1 trillion in revenue by 2030, with Musk even noting there's a non-zero chance they hit that trillion-dollar mark as early as 2029. Let's move to and see how this builds, because the roadmap to achieve these astronomical revenue targets reads straight out of a science fiction novel. During the call, Musk laid out some very specific future milestones: deploying autonomous robots to the moon, utilizing those robots to build a mass accelerator for launching materials, and establishing actual lunar manufacturing for things like solar panels and radiators. This whole vision culminates in claims of just unimaginable economic scale. Musk told investors that by marrying advanced AI with orbital robotics, SpaceX can eventually scale to, and I quote here, 1,000 times the economy of Earth, maybe even 1,000,000 times. We are simply reporting the stated goals here, but the scale of that ambition is pretty hard to wrap your head around. Which brings us right back to the ultimate paradox of this explainer. The record revenue, it's completely real, but so is the multi-billion-dollar cash burn, and so is the intense AI competition. The stock is falling because the brutal present reality of capital expenditure is clashing head-on with an unprecedented trillion-dollar promise of a spacebound future. So the final question you have to ask yourself when looking at all this data is simply this: are you investing in the reality of today's spreadsheet or the potential of tomorrow's sci-fi dream?